day for the Fed. We're expecting the smallest hike of the tightening regime yet. And for the market's expectations, there's a huge gap between what the Fed has told us they want to do as far as cuts later this year. Potential for some volatility. Let's talk about it some more. This time with Peter Higgins, head of fixed income, joining us, portfolio manager at Shelton Capital Management. Peter, welcome to the show. Big day today, or everything going to go smoothly? Powell going to give investors what they want?
Well, first of all, thanks for inviting me onto your show this morning. We're certainly having a timely conversation with markets eagerly awaiting the Fed's decision today. Listen, I think it's tough to fight consensus right now. Markets are implying a near 100% probability that the Fed will raise rates by 25 basis points this afternoon. So I won't buck the masses this morning, but I am very wary that market consensus is bucking the Fed's future outlook. And as you discussed throughout the morning, the Fed is guiding us towards a terminal rate above 5% and no cuts in 23, whereas the markets are currently pricing in just one additional hike after today before pausing in May and then implying actual cuts in the second half of 23. So I think we're status quo today, but going forward, there is going to be a bit of a tug of war between markets and the Fed.
Peter, how literally do you take the market's expectations for cuts? Because we talk about these things and everybody agrees on it. The market's pricing in cuts. But ultimately, it's just a spread between asset prices that can fluctuate, right? Do we know the reasons for why everybody buys things? I mean, we're at 3.5. Is there just a pension fund out there? Are there enough of them that just want to keep taking advantage of income at this level? Does it really suggest that if the Fed doesn't cut, there's like a big impasse? Walk me through the way you think about that.
Sure. I think overall, fixed income bond prices are really a reflection of market technicals and fundamentals. And your example about a big pension fund potentially buying rates is a great example of more demand than supply pushing rates lower. But at the end of the day, the Fed is going to be focused on fundamentals. And in this case, it's the economic backdrop that we're living in. I kind of jokingly say age-old adages exist for reasons. They tend to have been proven right over time. And markets now seem to have forgotten the one about don't fight the Fed. So I think this afternoon it'll be interesting to see if Powell uses the Fed statement and or his press release, press conference to take the opportunity to push back on markets. Will it be enough for the Fed to just reiterate their previous communications? Will the Fed highlight the difficulty they're having fighting inflation while recent financial conditions have been easing? Personally, I think that investors hoping for an immediate end to the Fed's rate hiking campaign or a pause are going to be severely disappointed. And Fed rhetoric will get louder, most likely at the press conference today and shortly thereafter by the other governors. So now, not exactly the right time to fight the Fed, but in any brief moment of time, technicals can outweigh the fundamentals.
Peter, the idea here that the language could shift. Afterwards we kind of look at the before and after statements. We'll say, okay, here's what they said last time, and the red stuff or the highlighted stuff is what changed. We're always kind of looking at that before and after. What do you think could be in the language change? I mean, how could he update his language to be a little bit more firm in a way that might make a difference? Or does he actually have to do something physical like add on to the tapering or something like that?
No, very good question. He's walking a tightrope here because he's been reiterating fairly hawkish words, throughout the last handful of months, but the market is choosing to ignore him. He's going to have to choose his words in the press release quite carefully. Does that mean he is more dovish and turns to a singular, rate cut, one additional rate hike, or is it remain plural, as in there might be more future hikes? That's going to be one key word. But I think the real fireworks are going to come in the press conference. And, I think we've seen that over the last two statements. The press conference does have a little bit more power to sway markets.
Is there a potential here that Powell will kind of put his foot down, draw a line in the sand, and maybe do something like a surprise hike or increased decreased asset purchases, rather increased taper? What are the odds of something physical beyond communication?
I think acting on that today, the odds are fairly low because the Fed governors have been pretty vocal and clear that we're hiking 25 basis points this afternoon. A 50 basis point move would certainly take the markets by surprise. I suppose there could be something more done on the quantitative tightening side that the market isn't quite forecasting right now. That's a possibility, and I think that would probably come up in the press conference, or at least him alluding to something in the future might come up on the press conference.
How are you guys managing the bond funds, and tell me what the strategy is with this said over the next 6 months or so? Where's the opportunity in fixed income?
So I think there's a couple opportunities. One, you've got to remember that in fixed income, the power of the coupon is a strong tool for fixed income investors. The more prolonged this battle against inflation is, the more coupon investors are clipping. Just about the only positive after 2022's disastrous returns is the fact that the entry point for investors today is historically attractive. Investment-grade corporate bonds are yielding nearly 5%. High-yield bonds are over 8%. Tax-exempt yields on muni bonds are as high as 5.25%. So time is on an investor's side to continue clipping these coupons while we await a resolution between what I call this tug of war between the Fed and the market. So how do you position today is a great question. One thing we haven't covered on this conversation yet is the price economies may pay for the Fed fighting inflation now is a future recession. It might be easy for investors to get caught up with the attractiveness of current yields, but with so much uncertainty out there and an inverted yield curve, many economists are predicting a recession. So fixed income investors are focusing on attractive yields, but they must not forget that spreads matter to total return. The spread is merely the difference between a security's yield and the underlying risk-free treasury rate. So after the rally we've had in the year-to-date period, spreads definitely are not pricing in a recession risk, especially in those lower-rated high-yield issuers. And nor are current high-yield spreads reflecting deteriorating issuer fundamentals. So on one hand, you've got the power of the coupon is good the longer this battle takes place. But on the other hand, higher inflation, higher rates are ultimately going to deteriorate issuers' margins and weaken corporate earnings. So there's a fine balance. What we're doing here at Shelton is refusing to chase yield and still prudently position for lower economic backdrop. And since those lowest rated securities are the most susceptible to further spread widening in a recession, we think the sweet spot for investments right now is twofold. One, at the cusp of investment grade. So straddling the lowest tier of IG and the highest quality high yield bonds. Even if spreads were to widen 150 to 200 basis points over the next 12 months, there would still be a positive return. And by the way, if spreads widen 200 basis points over the next couple months, that means the economy is in pretty poor shape. The second positioning we're doing is continuing to target selective high yield rated issuers with more idiosyncratic risk, more of a story to grow into their capital structures.
Okay. So
accurate fundamental credit research ultimately can capture greater capital price appreciation in those names and those sectors.
So it sounds like some of the junky stuff has been making a comeback, and you're steering clear of that as recession risk starts to maybe kind of get forgotten a little bit to some degree. We've seen in stocks, so to hear that it's happening in bonds means that optimism and maybe a little bit of complacency is indeed creeping in to the market strength here the last couple months. Peter, thanks for the insight. Appreciate the outline on what you guys are doing. Looking forward to catching up.
Great. Thank you very much for having me. Appreciate it.
Absolutely. Peter Higgins, Senior Fixed Income Portfolio Manager at Shelton Capital Management. It's not just froth in stocks, spreads, closing in bonds, and optimism for companies that may not have what it takes to get through an imminent recession still on the horizon.